Most options traders do not lose money because they pick the wrong direction. Most of them lose it on trades where the stock moved exactly the way they predicted. Nobody explained what was running against them the entire time. 9 out of 10 people who try options lose money in their first year. And the reason most of them quit is not that the market outsmarted them. It is that they could not understand why being right was not enough. The stock went where they said it would go. The position still went to zero. Here's the one sentence that explains all of it. An options contract is not a direction bet. It is a race against time. There is one variable embedded in every contract that destroys its value every single day, regardless of what the stock does. It ran while the market was closed this past weekend. It will run tonight. By the time any stock moves where you thought it would go, that variable may have already extracted so much from the contract that the move does not save it. You will know exactly what that variable is before this video ends. Here is what an option actually is. An option is a contract, not a share of the company, not a position in the stock. A contract that gives you the right to buy or sell 100 shares at a specific price before a specific date. The right, not the obligation. That distinction matters more than most people realize. If the trade goes against you, you walk away. You let the contract expire. The most you can lose is what you paid. That is the entire downside. The upside scales with how far the stock moves in your direction. Think of it like a deposit on a house. You put down $5,000 to lock in the right to buy the house at today's price for the next 90 days. If the house price jumps, you exercise that right and profit from the difference. If the market moves against you, you walk away and lose only the deposit. The deposit is your maximum loss. There are two kinds. A call option gives you the right to buy at a locked-in price. You buy calls when you think the stock is going up. A put option gives you the right to sell at a locked-in price. You buy puts when you think it is going down. Most explanations stop there. Direction, up or down. Here's the part nobody explains. A call option is not a bet that a stock goes up. It is a bet that a stock goes up past a specific price and that it does so before a specific date. Those two additional conditions, the price target and the deadline, are where options actually get priced. And those two conditions are where the race against time begins. But before you can understand how that race works, you need to understand what you are actually paying for when you buy a contract. The specific price the stock has to reach is called the strike price. The price you pay for the contract is called the premium. You have probably done this. You opened the options chain, saw the cheapest contract, noticed the potential return was the largest, and bought it. Here is why that instinct is working against you. A stock is trading at $100. You are looking at two call options. One has a strike of $105 and costs $250. The other has a strike of $120 and costs $40. The $40 option looks like the smart play, 6 times cheaper, same stock, same directional bet. But the $250 option only needs the stock to rise 5%. The $40 option needs the stock to rise 20%. Same expiration date, same 30 days. These are not the same bet at a discount. They are completely different probability calculations that happen to involve the same ticker symbol. Here is what most people miss completely. The premium is not arbitrary. It is the market's precise estimate of the probability that your specific bet succeeds by expiration. The $40 option is $40 because the market has already calculated that a 20% rise in 30 days is unlikely. The $250 option costs more because a 5% rise is far more probable. Every retail trader who reaches for the cheapest strike because the return looks biggest is buying the contract the market has already decided has the lowest probability of work. The price communicated that they did not know how to read the price. And there is a second thing embedded in every premium that almost nobody thinks about: time. Two call options on the same stock, same strike, different expiration dates. One expires in 7 days. One expires in 90 days. The 90-day contract costs dramatically more. You are paying for time because more time means more probability of reaching the target. Strip the time away and the probability collapses with it. The cheapest options on the board are cheap for exactly two reasons. The target is too far and the clock is almost out of time. But neither of those explains the hidden cost that was running against you from the moment you bought. That is what theta is. This is the variable from the opening of this video. Every options contract has a built-in daily cost called theta. Theta is the exact dollar amount your contract loses every single day from time passing alone. Not from the stock dropping, not from any market event, from the calendar advancing one more day. Theta runs while you sleep. It ran last Saturday. It ran last Sunday. From the moment you buy an options contract to the moment it expires, theta is transferring money out of your position and into the account of the person who sold you the contract. Every day, every hour. Regardless of what the stock is doing, most people have no idea this is happening to them. Here is what it looks like in practice. You buy a call option for $400. The stock is at $100. Your strike is $108, and you have 30 days until expiration. For 2 weeks, the stock does nothing. Not down, just flat. You check your position at the 2-week mark. The contract is worth worth $220. You are down almost half, and the stock has not moved against you a single day. You refresh the screen, thinking something is wrong. Nothing is wrong. Theta collected that difference while you waited for the stock to move. Then the stock finally moves. It rises 4% in the following week. You were right about the direction. You check the position. The contract is worth $270. You are still down over 30% from where you entered. The stock went exactly where you said it would go. Think about that for a second. Right about the stock, wrong about the clock. This is the mechanism that explains the opening statement. The stock moved the right direction. Theta had already extracted 60% of the contract's value before the move arrived. The move was real. It was not large enough, fast enough to overcome what time had already taken. Direction was right. The race against time was already lost. But here is where it gets worse. Theta does not run at a flat rate. An option with 30 days left loses less value per day than the same option with 7 days left. As expiration approaches, the daily decay accelerates. The last week before expiration is where most retail premium evaporates fastest. The market is pricing out any remaining probability that the option can work in the time left. Here's what that looks like in real numbers. A contract that loses $10 a day at 30 days out might lose $40 a day in the final week. Same contract, same stock price, 4 times the daily damage. The reason is probability. With 30 days remaining, there is still a meaningful chance the stock makes a large enough move. With 5 days left, that probability has collapsed to almost nothing. As probability falls, time value falls with it. That is the trap. Holding a losing options position into the final week waiting for a recovery is not patience. It is paying the highest possible daily fee on a position that is almost out of time to save itself. Most retail options accounts are not blown up by one catastrophic trade. They are drained slowly across many contracts in the final week of each one contract at a time, 1 week at a time, until the account is gone. There are 4 specific mistakes that follow from not understanding what Theta is doing. You will probably recognize yourself in more than one. The first mistake is reaching for the cheapest strike because the percentage return looks most dramatic. You have seen the viral screenshot, $40 into $3,000 in 4 days. That post gets shared constantly. What does not get shared is the 16 contracts the same person placed in the 4 months before that one. All expired, worthless. The account shows all 17 trades. Only one ever gets posted. You are not looking at a strategy. You are looking at the one time the lottery ticket paid. The second mistake is holding a contract while waiting for the move, not understanding that every day you wait costs money. The position is not simply unchanged while you hold, it is declining. The stock has to move more today than it had to move yesterday just to bring the position back to even because Theta ran overnight. In stocks, a flat day costs you nothing. In options, a flat day has a dollar amount attached to it. You paid for that day whether the stock moved or not. 10 flat days in Theta may have taken more from you than a small move against you would have. The position can lose value without a single bad thing happening to the stock. The third mistake is buying options before earnings without knowing what implied volatility does. Here is the part nobody talks about before earnings season. Every stock has a measure of how much the market expects it to move. This is called implied volatility, and it is one of the core inputs that determines what an option costs. When earnings are approaching, implied volatility spikes. The premium inflates because nobody knows yet what the results will show. Then earnings are announced. The uncertainty is gone. The market immediately removes the elevated premium. Your option can be right on the direction, right on the size of the move, and still lose 40% of its value in the first hour after the announcement. The volatility that inflated the price collapses the moment the unknown becomes known. And you were right, it still did not matter. This is called implied volatility crush. It happens every earnings season to traders who bought options expecting a big move and had no idea why they lost money when they were correct. Here is what it looks like in real terms. A company reports earnings after market close. Revenue beats by 20%. The stock jumps $7 in after hours trading. You open the app the next morning, your call option has lost 35% of its value overnight. The move you predicted happened. The stock went exactly where you said it would go. But the volatility that inflated the premium collapsed the second the report dropped. The uncertainty was the premium. Once the number was known, the uncertainty was gone. The price adjusted before you could do anything about it. The fourth mistake is never looking at the Theta value before buying. Every brokerage platform shows Theta in the options chain. It is right next to the premium, a small negative number. Negative 0.40 means the contract loses 40 cents per day from time alone. On a $2 contract, that is 20% of the position gone in 1 week before the stock does anything at all. Most retail buyers open the chain, look at the potential gain, and click buy. They've never been shown the Theta column or told what it means. It is the most important number on the page, and almost nobody looks at it. Every one of those 4 mistakes has one thing in common. The buyer did not know the full terms of the race they had entered. The seller did. Here is what the other side of your trade looks like. When you bought that contract, someone sold it to you. That seller collected your premium the moment the trade executed. They now hold a position that profits from every single day that passes without the stock reaching your strike. A stock is at $100. You buy a call with a strike of $115, expiring in 30 days for $150. The seller received that $150 immediately. For the seller to lose money, the stock has to close above $115 by expiration and finish far enough above it to exceed what they already collect. If the stock closes at $112, the seller keeps everything. Flat for 30 days, the seller keeps everything. Stock drops, the seller keeps everything. The only scenario that costs the seller is a large, fast move above the strike before time runs out. Everything else is their profit. They collect theta every day. You pay theta every day. The people on the other side of these trades are not retail investors taking the opposite directional bet. They are institutions, market makers, and professional traders who have already run the probability calculation before the transaction happens. They set the premium price. You agreed to it. The math was already built into the number you paid. The seller does not need to know the stock better than you. They need the clock to run before the stock reaches your target, and the clock does exactly that most of the time. This is why professional traders primarily use options as sellers, not buyers. When they do buy options, it is because they have calculated that the market has underpriced the probability of a large, fast move in the available time. They do not buy calls because a stock looks bullish. They calculate whether the race against time is one they can actually win before they enter it. That is not how most people approach it. Here is what you now know. An options contract is not a direction bet. It is a race against time. The stock has to move in the right direction past a specific price before the clock runs out. Direction is only the first condition. Strike price sets the target the stock has to reach. The premium reflects the probability the market assigns to reaching that target in the available time. Cheap options are cheap because the target is too far and the clock is almost gone. Theta is the daily cost of holding the contract. It runs every hour, regardless of what the stock does. It accelerates in the final week before expiration. Most retail losses happen not because the direction was wrong, but because the stock moved too slowly for theta to be outrun. Implied volatility is the second hidden cost. It collapses the moment the uncertainty that created it disappears. Sellers collect theta, buyers pay it. The professionals who consistently make money in options are primarily on the selling side. Most people who lose money in options were not wrong about the stock. They were wrong about the clock. And now you know the difference. Open the options chain on any stock you follow right now. Find the theta column. The number next to each contract is exactly how many dollars it loses every single day from time alone. Look at the 7-day expiration contracts. Look at those numbers. That is the clock. That is the variable that was running in every trade that ended exactly the way the opening of this video described. Look at it before you buy.